Real estate investing offers multiple avenues for generating income and building wealth. Understanding these methods can help you choose the strategies that align best with your goals and risk tolerance. This chapter explores the various ways to make money in real estate, along with some common rules of thumb used by investors. Quick flips. Turning properties for profit. Quick flips involve buying properties at a low price, making improvements, and selling them quickly for a profit. This strategy requires keen market knowledge, the ability to accurately estimate renovation costs, and a good sense of timing. Advantages: potential for high profits in a short period. Disadvantages: requires significant upfront capital and expertise. Market fluctuations can impact profitability. Rule of thumb: the 70% rule. Purchase price plus renovation costs should not exceed 70% of the property's after repair value, or ARV. Rental income. Building passive cash flow. Rental properties generate monthly income through rent payments. This strategy provides a steady cash flow, potential appreciation, and tax benefits. It requires property management skills or hiring a property manager. Advantages: consistent income, long-term appreciation, and tax benefits. Disadvantages: requires ongoing property management and maintenance. Rule of thumb: the 1% rule. Monthly rent should be at least 1% of the property's purchase price. Capital preservation and land banking. Holding for the long term. Capital preservation and land banking involve purchasing properties or land with the expectation that they will appreciate over time. This strategy is less about immediate cash flow and more about long-term gains. Advantages: lower management effort, potential for significant appreciation. Disadvantages: tied up capital with no immediate income, requires patience and a long-term perspective. Rule of thumb: there are no specific percentages, but investors typically look for properties in high-growth areas or regions with planned infrastructure improvements. REITs and real estate crowdfunding, investing without direct ownership. Real estate investment trusts, or REITs, and crowdfunding platforms allow investors to invest in real estate without owning physical properties. These options provide exposure to real estate markets with lower capital requirements. Advantages include diversification, liquidity, and lower entry barriers. However, there are disadvantages such as limited control over investments and reliance on the management team. As a rule of thumb, REITs often aim to provide a dividend yield higher than typical stocks, often around 4 to 8%. Short-term rentals. Leveraging the sharing economy. Short-term rentals involve renting out properties for short durations, often through platforms like Airbnb or VRBO. This can generate higher rental income compared to traditional long-term leases. The advantages here are higher rental income and flexibility in property use. On the flip side, it requires active management, compliance with local regulations, and there's potential for high vacancy rates. A rule of thumb to keep in mind is the occupancy rate rule. Aim for an occupancy rate of at least 60 to 70% to ensure profitability. Commercial real estate diversifying income streams. Commercial properties include office buildings, retail spaces, and industrial properties. These properties typically have longer lease terms and can provide stable income. The advantages are long-term leases, diversified income streams, and the potential for higher returns. However, the disadvantages include higher entry costs and market sensitivity to economic cycles. The cap rate rule is essential here. Calculate the capitalization rate, or cap rate, by dividing the net operating income, or NOI, by the property's current market value. A higher cap rate indicates a potentially better investment, typically ranging from 5 to 10%. House hacking. combining living and investing. House hacking involves living in one part of a property while renting out the other parts. This strategy helps cover mortgage payments and other expenses. Advantages include reducing personal housing costs and generating rental income. However, it does require sharing your living space with tenants. A useful rule of thumb is the house hacking rule. Ensure rental income covers a significant portion, if not all, of the mortgage and housing expenses. Wholesaling. Profiting without owning. Wholesaling involves finding undervalued properties, getting them under contract, and then selling the contract to another buyer for a profit. This strategy doesn't require owning the property. Some advantages are lower capital requirements and quick transactions. On the downside, it requires strong negotiation skills and a network of buyers. The assignment fee rule is a good guideline aimed to earn an assignment fee of 5 to 10% of the property's contract price. Conclusion. Choosing your path to profit. Real estate offers a variety of ways to make money, each with its own advantages and challenges. By understanding these methods and applying common rules of thumb, you can develop a strategy that fits your financial goals and risk tolerance. Whether you prefer the fast profits of flipping, the steady income of rentals, or the long-term gains of land banking, real estate provides a versatile platform for building wealth. Chapter 5. The Asset Key Factors in Real Estate Investing. Investing in real estate requires a deep understanding of the various factors that contribute to a property's value and its potential for generating income and appreciation. Let's delve into the key elements that define a real estate asset and guide your investment decisions. Types of real estate, a diverse spectrum. Real estate encompasses a wide range of property types, each with its own distinct characteristics and investment potential. Residential properties like single-family homes and multi-family apartments cater to different housing needs, while commercial properties like office buildings, retail spaces, and industrial warehouses serve various business purposes. Understanding the nuances of each type is essential for tailoring your investment strategy to your specific goals and risk tolerance. Location, the cornerstone of value. The age-old adage location, location, location holds true in real estate investing. A property's location is a primary determinant of its value, desirability, and potential for appreciation. Prime locations, those with proximity to schools, employment centers, transportation hubs, amenities, and desirable neighborhoods, command higher rental income and property values. Analyzing neighborhood trends, demographics, and future development plans can help you identify areas poised for growth and maximize your investment potential. Potential profit and cash flow, the financial engine. Assessing a property's potential profit and cash flow is crucial for any investor. This involves analyzing rental income projections, operating expenses such as property taxes, insurance, maintenance and repairs, and financing costs to determine the property's net operating income, or NOI. A positive cash flow indicates that the property generates more income than it costs to operate, providing a consistent return on investment. Additionally, calculating potential profit includes factoring in appreciation, which is the increase in property value over time, and any potential tax benefits associated with real estate ownership. Size of the deal scaling your investment. The size of a real estate deal can range from a modest single-family home to a sprawling multi-million-dollar commercial complex. The size of the deal dictates the amount of capital required, the complexity of financing, and the potential returns. Larger deals may offer economies of scale and higher profit margins, but also come with increased financial risk and management responsibilities. It's essential to assess your financial capabilities, risk tolerance, and investment goals to determine the appropriate size of the deal for your portfolio. Operations, the art of property management. Efficient property management and operations are vital for maximizing the value and profitability of your real estate asset. This includes everything from maintaining the property's physical condition to screening and managing tenants, collecting rent, and addressing any issues that arise. Effective operations can minimize vacancies, reduce expenses, and enhance tenant satisfaction, all of which contribute to higher returns. You can choose to manage the property yourself or hire a professional property management company to handle day-to-day operations, depending on your expertise and available time. Exit strategies planning for the future. Every real estate investment requires a well-thought-out exit strategy. This outlines your plan for eventually realizing the returns on your investment. Common exit strategies include selling the property outright to capture capital gains, refinancing to access equity without selling, or holding the property for long-term appreciation and cash flow. Your exit strategy should align with your investment goals and timeline, taking into account market conditions and potential tax implications. Evaluating real estate assets involves a comprehensive analysis of various factors that contribute to their value and potential. By considering the type of property, its location, potential profit and cash flow, the size of the deal, operational requirements, and exit strategies, you can make informed investment decisions that align with your financial goals and risk tolerance. Remember, thorough research, due diligence, and a long-term perspective are essential for achieving success in real estate investing. By mastering these key aspects of real estate assets, you'll be well equipped to navigate the complexities of the market and build a profitable and sustainable real estate portfolio. Chapter 6. The Real Estate Transaction Process. A step-by-step guide to success. Successfully navigating a real estate transaction requires a systematic approach, ensuring a smooth and efficient journey from property identification to post-acquisition management. Here's a detailed look at the real estate transaction process, outlining the key steps in a logical sequence. Step 1. Identifying the property. Finding your ideal investment. The first step is to identify a property that aligns with your investment goals. This involves thorough research and analysis, considering factors like location, property type, potential for appreciation, and cash flow projections. Utilize online resources, network with industry professionals, and leverage your local market knowledge to uncover potential deals. Step 2. Conducting due diligence. Evaluating the investment. Once you've identified a promising property, it's crucial to conduct comprehensive due diligence. This involves a thorough investigation of the property's financial, legal, and physical aspects. Analyze financial statements, review leases if applicable, conduct inspections, and assess market conditions to ensure the property meets your investment criteria and to uncover any potential risks or red flags. Step 3. Making an offer. Securing the deal. With due diligence complete and confidence in the property's potential, it's time to make a formal offer to the seller. Your offer should be based on your analysis and valuation of the property, taking into account market conditions and comparable sales. Be prepared to negotiate terms like the purchase price, contingencies, and closing timeline to reach a mutually beneficial agreement. Step 4. Securing financing. Funding your investment. After your offer is accepted, securing financing becomes a priority. This involves obtaining loan quotes from multiple lenders to compare interest rates, terms, and fees. Choose a financing option that aligns with your investment strategy and budget, ensuring you have the necessary funds to complete the purchase. Step 5. Finalizing the purchase, sealing the deal. With financing secured, you can proceed to close the transaction. This involves finalizing all legal and financial paperwork, conducting a final walkthrough of the property, and ensuring all contingencies have been met. Once everything is in order, you'll sign the closing documents, transferring ownership of the property to you. Step 6. Making initial contact. Establishing a relationship. While often occurring earlier in the process, making initial contact with the seller or broker can be beneficial even after securing the property. Building a positive relationship can be helpful for future transactions or for addressing any post-closing matters that may arise. Step 7. Property management, maximizing value. After acquiring the property, effective management becomes paramount. This includes regular maintenance, tenant screening for rental properties, rent collection, and addressing tenant concerns promptly. Efficient property management ensures a steady stream of income, minimizes vacancies, and protects your investment's value. You can choose to manage the property yourself or engage a professional property management company. Step 8. Enhancing revenue. Optimizing income streams. To maximize your return on investment, explore strategies for increasing the property's revenue potential. This could involve renovations or upgrades to attract higher-paying tenants, adjusting rental rates to match market conditions, or exploring additional income streams like parking fees or vending machines. Step 9. Preparing for sale or refinance. Strategizing your exit. As your investment matures, consider your long-term goals and potential exit strategies. This could involve selling the property to capitalize on appreciation, refinancing to access equity for other investments, or holding the property for continued cash flow. Careful planning and analysis are crucial for choosing the most advantageous exit strategy. Step 10. Executing the exit strategy. Realizing your returns. When the time is right, execute your chosen exit strategy. If you're selling, work with a real estate agent to market the property effectively and negotiate the best possible price. If you're refinancing, shop around for the most favorable terms and rates. Executing your exit strategy successfully allows you to realize the fruits of your investment and move on to your next venture. Chapter 7. Financing Real Estate Investments, a guide to lenders and loan types. Securing financing is a critical step in the real estate investment process. Different property types often require specific loan structures and lenders who specialize in those sectors. Understanding the options available for each property type can help you navigate the financing landscape and choose the most suitable path for your investment goals. Residential real estate. Apartments. Commercial banks offer commercial real estate loans specifically for multi-unit residential buildings. Credit unions provide financing for apartment buildings, often with competitive rates and a more personalized approach. Government-sponsored enterprises, like Fannie Mae and Freddie Mac, offer multifamily loan programs with attractive terms for qualified borrowers. Agency loans, such as HUD FHA loans, are available for affordable housing projects, providing government-backed financing with potential benefits. Apartments. Commercial banks offer commercial real estate loans specifically for multi-unit residential buildings. Credit unions provide financing for apartment buildings, often with competitive rates and a more personalized approach. Government-sponsored enterprises, like Fannie Mae and Freddie Mac, offer multifamily loan programs with attractive terms for qualified borrowers. Agency loans, such as HUD FHA loans, are available for affordable housing projects, providing government-backed financing with potential benefits. Single-family residences, also known as SFRs, offer various financing options to suit different borrower needs. Traditional mortgage lenders, including banks, credit unions, and mortgage companies, provide conventional loans with varying terms and interest rates. For those who qualify, government-insured loans like FHA, Virginia, and USDA loans offer lower down payment options and flexible credit requirements. Portfolio lenders, who keep loans on their books rather than selling them, can offer more flexibility and potentially faster approval times. Lastly, hard money lenders provide short-term asset-based loans with higher interest rates, ideal for borrowers with less than perfect credit, or for properties requiring quick financing. Mansions, the epitome of luxury living, have their own specialized financing options. Luxury home lenders specialize in jumbo loans for high-value properties that exceed conforming loan limits, often with tailored terms and higher loan amounts. Private banks cater to high-net-worth individuals, offering personalized service and access to exclusive loan programs. Additionally, portfolio lenders may be willing to finance unique luxury properties that don't fit traditional lending criteria. Mobile homes, a unique segment of the housing market, come with their own set of financing solutions. Manufactured home lenders focus on financing mobile homes and mobile home parks, understanding the unique aspects of this niche market. Chattel loans, or personal property loans, are used for mobile homes on leased land, treating the home as personal property rather than real estate. For those looking for government-backed options, FHA Title I loans are available for the purchase, refinancing, or improvement of mobile homes. Commercial real estate. Retail commercial banks offer commercial real estate loans tailored for retail properties, considering factors like location, tenant creditworthiness, and market conditions. SBA 504 and 7 AA loans are government-backed loans with favorable terms and lower down payment requirements for eligible small businesses. Life insurance companies often invest in large-scale retail projects, providing long-term, stable financing. Retail commercial banks offer commercial real estate loans tailored for retail properties, considering factors like location, tenant creditworthiness, and market conditions. SBA 504 and 7A loans are government-backed loans with favorable terms and lower down payment requirements for eligible small businesses. Life insurance companies often invest in large-scale retail projects, providing long-term, stable financing. Office commercial banks and institutional lenders provide conventional loans for office buildings, often with longer terms and amortization periods. CMBS loans, or commercial mortgage-backed securities, are pooled commercial mortgages sold as bonds, offering competitive rates for stabilized office properties. Bridge loans offer short-term financing for office properties undergoing transitions, such as renovations or leasing up. Self-storage. Self-storage lenders specialize in this niche market, understanding the unique characteristics and financial considerations of self-storage facilities. SBA 504 loans can be used for the construction or expansion of self-storage facilities. Conventional commercial lenders may also provide financing. Land. Undeveloped land. Banks and credit unions offer specialized loans for raw land purchases, often with shorter terms and higher interest rates due to the higher risk associated with undeveloped property. In some cases, the seller may offer financing to the buyer, providing a flexible alternative to traditional loans. Undeveloped land. Banks and credit unions offer specialized loans for raw land purchases, often with shorter terms and higher interest rates due to the higher risk associated with undeveloped property. In some cases, the seller may offer financing to the buyer, providing a flexible alternative to traditional loans. Other real estate investments: industrial, hospitality, and healthcare. These sectors have specialized lenders who understand the specific needs and financial considerations of these property types. Financing options include conventional commercial loans, CMBS loans, SBA loans, and private equity investments. Industrial, hospitality, and healthcare. These sectors have specialized lenders who understand the specific needs and financial considerations of these property types. Financing options include conventional commercial loans, CMBS loans, SBA loans, and private equity investments.